let's go deep into what's happening from an economy point of view, especially the U.S. And the global economics. We have Claudio Irigoyen, head of global economics research at Bank of America Global. Claudio, thank you very much for joining us. Let's start off with how do you look at this entire West Asia crisis impacting economies, and who do you think, or which economies do you think will be the worst impacted?
In a nutshell, we see this war as a stagflationary shock for the world economy. That means somewhat lower growth and higher inflation. It's basically a supply shock at this point, and the impact, the permanent impact, will depend on how long the war is, for how long um, the supply disruptions last, in particular, obviously, the Strait of Hormuz. And that will determine the persistence of the shock. We are working under the assumption that there will be some type of resolution, at least in the reopening of the Strait of Hormuz in the near future. There is a lot of uncertainty, obviously. We heard President Trump saying that the deal is imminent, but we've heard that many times already since the war started. So there is a lot of uncertainty. But in a nutshell, what we have done is to reduce, since the war started, global growth a few tenths to capture the persistent part of the shock and the damage that is already done to the global economy, even if the war ends tomorrow. So we had a 3.5% global growth forecast before the war. Now we have 3.1%. For the US, we now expect 2.3% growth. It's still a pretty good number for the US. India, in particular, will reduce growth to 6.5%. About 50 basis points versus the pre-war level. And obviously, we expect some temporary increase in inflation. In terms of the countries that will be more impacted, obviously, it's going to be oil importers. Europe will suffer more than the US. India, being an oil importer, obviously, it's a negative shock. China and Japan, which are natural oil importers, so far has not been impacted that much because they have huge inventories of oil. So in order for those economies to be impacted more heavily, you need more persistence in the shock. In terms of central banks, we expect the Fed not to change interest rates in the near future. We expect some hikes from the ECB. Eventually, we expect some hikes by the RBI at some point towards the end of the year, beginning of next year. But the persistence of the shock will determine whether central banks will react or not, and whether inflation expectations move accordingly. Otherwise, it's a supply shock that you can look through as long as inflation expectations remain anchored.
And Claudio, what's your sense with regard to second order impact of the crude shock, which is there? First order being that being what you've kind of spelled out very beautifully. Well, what's the second order impact, both across economies as well as companies' earnings and the like? What's the assessment there?
Again, I think, sorry to be repetitive, but I think it's again a matter of whether this is a temporary shock, relatively short-lived, or permanent. Now, what is important here is that even if the war ends tomorrow, we don't expect energy prices to go back to the pre-war level. So there will be a permanent level of disruption. It's going to take a lot of time to normalize not only distribution, but also production in the Middle East. Obviously, other countries step up in production, in particular the US, but replenishing inventories in in China and in Japan is going to take time. So you shouldn't expect oil going back to low 70s or high 60s. It's probably more a story of oil around low 90s, mid 90s, something like that.
Claudio, do you think that it will take a longer time to go for oil to pre conflict levels, maybe early next year? Can it extend to early next year? And is that the timeline do you have, or is it going to be much longer?
It could last longer. It depends again. It depends on the length of the war. Um, you you and I could have agreed a month ago that the war was going to end in a week or so. A month later, we're still wondering whether this can happen. So if the war extends, let's say, throughout the summer, first of all, the dynamics of oil prices will be very nonlinear because inventories will get exhausted and you need to replenish them. And it feels like the market is too much in the thinking that this war is going to be a short one, and therefore inventories are deep enough to deal with that. If the war extends throughout the summer, the pressure will be much higher, and it doesn't look like that's a story that is priced in at this point.
And another impact, Claudio, would be with regard to inflation, because many of the central banks will now be watching more closely with regard to the inflation print rather than growth, frankly, even in the US. What's your outlook? You expect inflation to be sticky? Does the focus shift back to inflation for many of the central banks, including the Fed?
Yes. So we think inflation is going to be somewhat sticky, but we need to differentiate the inflation dynamics that you had before the war and the extra kick in inflation because of the war. Obviously, everything that is directly related to energy prices, you're going to have an impact. But if you exclude the more volatile items and you focus on core inflation, obviously the impact is way more measured. The US economy in particular is much less sensitive to oil shocks than in the 70s or the 80s. And both on the inflation side and on the growth side in particular, because it's now a net exporter of energy. But what concerns me the most to me on the inflation side, that the inflation was persistent, core inflation was persistent and close to 3%, which is to me a high number before the war. So, and interestingly, the Fed was pretty comfortable with that, and the market was pricing in a couple of cuts for this year with that persistent inflation dynamics before the war. Now people are thinking about hikes. It's probably too early. I think the Fed, especially with a new chairman, will wait until having enough and conclusive evidence that inflation is more persistent at a higher level than before the war. Because as I said before, if this is a temporary shock, you should look through and not hike interest rates for that reason. As I said before, I don't think, or I didn't think before the war that the economy needed cuts. Less so now. Now we'll watch hike interest rates. Probably he will try to be hawkish on the rhetoric, but you're going to have very conclusive evidence for this new Fed to hike interest rates based on this shock.
Interesting, Claudio. How do you think emerging market central banks would be managing this crisis? And do you think what would be their reaction?
Well, again, emerging markets has to be differentiated between energy importers and energy exporters. So, for instance, for Latin America, this is a relatively positive term of trade shock. because most of, with the exception of Chile and Peru, the other countries are energy exporters, and commodity prices in general are moving higher. So not only oil, but also copper, gold, and this is a positive term of trade shock for many countries in Latin America. Oil imports is a different story. China is an oil importer, but India is also an oil importer. And as you mentioned, the current account deficit in some countries, India is one of them, is worsening and is putting pressure on the currency. The interesting thing about the current account deficit in India is that it's worsening, but aggregate savings are moving higher in India. The current account deficit is higher because investment is moving higher even faster. And the reason why it's putting pressure on the current account is because a big chunk of the investment that you should call it domestic absorption, it's feeding through imports of machinery and stuff like that. In particular, imports from China, that is the main trading partner now, used to be the US, but now it's China. So if that investment, if those imports are going to increase the productive capacity of the economy in India, I wouldn't be so concerned about the current account deficit, because it's a good current account deficit. If this is going to end up in unproductive sectors, or even worse, one way or another, financing consumption, that's obviously a different story. But the truth of the matter is that yes, that plus the energy shock is putting pressure on current account deficits and putting pressure on currencies, and that's why we are now more on the camp that central banks of those countries, India one of them, might be not so keen to cut interest rates, and definitely more staying on hold or hiking interest rates if needed.
Okay, and Claudio, what do you think of emerging markets like India? Would they also go for a hike with regard to interest rates, and maybe much earlier than other markets, maybe earlier than developed markets as well?
Not necessarily. For instance, if you compare Europe, Euro area versus India, probably the ECB will hike before RBI. But once again, it depends on whether this shock of energy prices exacerbates in the coming months because the war doesn't end, or on the other hand, sort of a taper because the war ends relatively soon and the market move on and focus on other stuff. The war is there. There is a lot of uncertainty about what should happen to energy prices, and the stock market in the US is going up every single day, right? So there are other stories also that are moving markets, the AI story in particular, that now the markets are focusing more on that rather than on the energy shock, again, because the perception is that the war will end relatively soon.
All right, thank you so much, Claudio. We'll let you go on that note. Gives us some perspective as to how you're looking at the economy as a whole, given this backdrop of West Asia, but so much uncertainty.